Well, good morning to everyone who has shown up. TGIF, it's been one of those weeks. Not a lot of new information, and I don't think we've really learnt a lot over the course of the week, but that hasn't stopped a lot of interesting price action, which we'll get into in just a moment. Before we go and start, I'll get you to go and read the risk warning on your screen. Remind you that this is entirely general advice in nature. And if you do want to go and ask any questions, and I encourage you to go and do so, any responses will be mine, not that of City Index or StoneX Group, the parent company, and it will be your choice to participate in that particular forum. I'll get you to just go and finish that. I'll go and jump on and you'll see what I'm up to in about 20 seconds or so time. Well, let's get into it. Actually, I'm a bit low here, hang on. There we go, that's better. Look, thanks everyone who's shown up. It's been an interesting week. I won't say it's been an exciting week. Of course, we had NVIDIA, which really dominated proceedings, but then when it actually arrived, it turned out to be a bit of a fizzer, which is probably a good thing, but I'm not surprised a little bit when you look at some of the details, maybe a little bit skinny when it came to some of those forward guidance, but realistically another really solid set of numbers. But apart from NVIDIA, it's really just been a continuation of the trends that we've seen recently, and that is about the dominance that US Treasury yields, the US Fed outlook are having on broader markets. So I thought today I'm just going to go and concentrate on what matters. There is so much noise out there in this financial world that we've got to go and deal with that it literally can go and tie yourself in knots and you can get really confused. So focus on the things that matter, and hopefully today that's what I'll do. So there'll be a focus on what's been going on when it comes to the long end of the US Treasury curve, its impact specifically on what's been going on in commodity markets and FX, and then we'll have a look at some technicals, which I've got to say have been very, very obedient and explain a lot of the price action and a lot of the narratives that we've heard discussed in media and the like over the course of this week. Let's get straight into it. I'm going to go and kick off looking at some rolling correlation analysis here on the screen. All right, so what are we looking at here? Up the top, US 10-year Treasury note yields. That's the underlying variable that we're looking at here. And we're looking at basically the rolling correlation over the past month on a daily time frame. And I just want to go and reinforce just how influential the back end of the curve is when it comes to these markets right now. It's not the only factor to consider, but it's really, really influential. And it's not a case of correlation does not equal causation. This is a lot of the causation right here. I can promise you that. So let's go and kick off the top. And I thought I'd go off something that we haven't got a lot of exposure to when it comes to some of the markets we look at, but it's interesting nonetheless. Copper futures, COMEX copper, over the past month, negative 0.87. So what that means, when yields go and move in one direction, almost always COMEX copper goes the opposite. So much for fundamentals, but hey, that's what's been really influential over the course of the past month or so. But it's not the only market that we've seen that. In black, same deal, 20-day rolling correlation over the past month with gold, negative 0.83. So nearly a stronger relationship. Silver, negative 0.84. Dollar yen, positive 0.84. So when yields go higher, yen typically goes higher as well. And that was much stronger up until this week. I think some of the headlines that came out involving Ukraine and Russia maybe went and weakened that a touch, considering where the levels it have been at. But realistically, that's the long end of the curve is incredibly influential when it comes to dollar yen in particular. Same too when you're talking about euro dollar in red here, negative 0.84, yields go higher. Typically what we see is euro dollar goes lower. And when you look at that one in particular, I've done some more analysis on that. It's really the spread differential between US yields and German bunds, depending on which time frame, but over a 10-year time frame in particular, has been very, very tight over the past month. So that's really, really strong too. And just reinforcing that point as well, cable, showing the bottom in purple here, that is sitting at negative 0.86, so even stronger than euro. When you look at some of the other currencies out there, Aussie, Kiwi, CAD, and the like, the relationship is not quite as strong. Is more related to what's going on when it comes to Fed funds futures, the expectations of what the Fed will go and do over the next 12 months or so with interest rates. that's really been the driving force there rather than the back end of the curve. So just keep that in mind if you're punting Aussie or Kiwi or CAD or any of the other commodity currencies out there right now. So knowing about the influence that we're seeing with 10-year Treasury yields, the key question that comes next is, well, what happens? Where do they go from here? Because if this stuff continues to go and be the dominant driving force next week, which I think it will when we get to look at the economic calendar coming up, it really reinforces, okay, well, we need to know what yields are going to do to go and give us some directional hints as to know how do we go and play these markets. Do we sell rallies? Do we buy dips? What's the way to go and do this? So let's have a look at what the rates world is saying is at the immediate front end of the curve. Okay, so what are we looking at here? 4 hourly charts, and basically on the left-hand pane here is the market pricing essentially for what the Fed may go and deliver when it holds its December FOMC meeting. And it's got about 11.5 basis points priced. It's a little bit less than what we have for OIS markets, which are more about 50-50 in terms of what the Fed may do. But the Fed meeting in December, whether they cut another 25 or not, is literally a coin flip. At this point in time, we don't know, and unfortunately next week, we're probably not going to get any answers to that. I suspect that what we'll get when it comes to what December will come from the next jobs report, the November payrolls report that will be released in early December. That will be the really, really key one to go and watch, along with the latest CPI and PPI data that will also come out before that event. And just demonstrating that what we're seeing at the moment is that markets continue to go and slash the amount of easing they expect the Fed to go and deliver over the next year. This is pricing out to the end of 2025. 74 basis points. That's 3 cuts coming through from now until the end of next year. So you talk about the Fed, and they've been really out there trying to go and push the narrative of, hang on, right now, we're looking to go and slow the pace. They're seeing what we're seeing. The economic data is really strong. We know Donald Trump wants to come in and be pretty free-wheeling when it comes to fiscal stimulus as well. When you look at that, it's not surprising. You could probably go and make the case right now that maybe that's even looking a little bit rich. Maybe they could go and strip that out a little bit as well. And in the right-hand pane here, just to go and demonstrate the impact that it's having on the longer end of the curve. So this is the US 2s 10s curve. You might hear it. It sounds a bit wonkish. For those of you not in the rates universe who were brought up in the rates universe, what it essentially is exactly what's on the ticket up here. It's US 10-year yields less US 2-year yields. And it gives you an expectation of what the market sees as relative growth and inflation moving forward compared to what we're looking at around about now. And what you can see is that there's been a big steepening of that curve. It was negative for a long period of time, and that was suggesting that we'd see growth and inflation weaker in the future than what it is today. But all of a sudden it's gone and flipped positive. Part of that's the fact that the Fed has started to go and cut rates, the front end of yields have gone and moved lower, but also what Donald Trump has done. But the fact that we've got this big repricing in Fed rate cut expectations and really stripping back the amount of cuts that are expected, you're seeing now that, yes, it's a bit volatile and everything else, but the general trend now is starting to go and flatten out. And so what does that mean? Well, it means that when it comes to directional risks, the fact that the Fed is becoming pretty, acknowledging that there's some strength in the US economy and talking about slowing down the pace of rate cuts. Well, less rate cuts equals probably more restrictive policy, which should, in theory, go and slow growth and economic and inflationary forces down. So right now, what the Fed pricing is doing, it's actually keeping a lid on longer dated yields, at least for the time being. Now, let's have a quick look at what the price action is telling us in US 10-year Treasury note futures. This is not going to be in a lot of people's radars, but I can promise you it should be. And I'm just going to go and just adjust this because I don't use adjustment on other futures contracts. But like any other market, you can go and apply technical analysis to this. You can go and look at volumes going through. You can look at what's going on with price momentum. And it gives you a pretty good deal and a pretty good signal as to exactly what's going on without having to go and pay attention to all the headlines about this person saying that and whatnot about the rate outlook. This is the cumulative view of what traders around the world are thinking about the path of US 10-year Treasury yields moving forward. So this is price, of course. So let's just go and reinforce that price moves inversely to yields. Tick that one off straight away. So what we're talking about there is when the price goes lower, yields go higher. And when the price goes higher, like we saw back earlier this year, yields go lower. So a lot of the price action that you've seen in the back end of the US Treasury curve recently can be explained by this trend line. And that's not me trying to go and make something that is not. That legitimately to me is just as powerful force as any of the stuff you hear regurgitated day in, day out. To me, that's really important because look at this. First established, rejected, 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 rejected. Came close again earlier this week, rejected. People are watching it. Now, don't worry about this big spike in volume. That's to do with the contract roll coming through. You can see that often happens towards the end of calendar months. You can see here. Now, but realistically, the price action we're seeing at the moment is stuck in a downtrend. However, momentum, ever so fractionally, is now starting to go and turn. You can see there's actually a bit of divergence coming through. RSI 14 on the daily time frame has been starting to go and push high and remains in an uptrend. And that signal has been confirmed by MACD. So momentum is suggesting, well, hang on, maybe we're seeing the biggest amount of the downside flush. And when you talk back to what the Fed rate cut expectations are and the impact that's having on growth and inflation moving forward, that's not really too difficult to understand. It kind of makes sense. So what now? I'm watching the price action here. We can see this price last Friday, we saw a pretty decent bounce, a hammer candle. Was that the lows? Well, we don't know yet is the answer. We've had some pretty inconclusive price action, although we do know that still that downtrend has been respected. But I think at some point here, look, this range is getting narrower and narrower and narrower. We'll go and get a sense as to exactly what we're looking at from here pretty soon. But if we were to go and see this trend line broken, and 113 it actually is here. It's been moved a little bit. Let me go and get this up. 113 of the price. You can see the price is on a lot of action around that either side. If that was to go and be breached as well, there's not a lot to go and talk about until you start getting back towards a 200-day moving average and the like. So there would be room for the price to go and rally and for yields to come lower. And going back to our original point, looking at the correlation analysis, that suggests that you'd probably see a softer US dollar, maybe some upside for commodities, gold, copper, silver, and maybe some relief for the beleaguered euro and Japanese yen, and the pound you could probably throw into that list as well. So right now we don't have a conclusive signal, and I wish I could go and tell you, but right now keep a really close eye on that trend line because that's going to be pretty important, you'd imagine, on FX, rates markets, commodity markets, and maybe even some of those more riskier asset classes out moving forward, although it's not quite as strong as a relationship as we've seen in the past. With that in mind, let's go and have a look at what comes up in the week ahead. And again, just a quick reminder, anyone listening in, watching in, who wants to go and ask any questions, please shoot them through and I'll endeavour to go answer them. But thanks to everyone who's turned up today. All right, so first and foremost next week, we've got Thanksgiving in the United States and Canada as well on Thursday. Hello to my Canadian followers who are out there as well listening on. Which means it's going to be a pretty quiet week. Lower volumes generally, and then Friday, whilst technically markets are open, you can kind of write it off as being an important day when it comes to anything meaningful signals coming through, because just literally there's going to be so little participation going through as everyone tries to digest the turkey from the night before. So looking at the economic calendar, much like this week, there is not a lot to go and hang your hat on, which could potentially go and drive the front end of the US curve, Fed interest rate expectations, and also the back end of the curve. And that's despite some pretty big data releases coming out. And I'll explain that in a second. So looking across here, Kiwi retail sales data, this is not going to get a lot of attention, but we'll get to the RBNZ in a second because they're going to announce an interest rate decision next week. And there is a very strong possibility that they could go and deliver a 75 basis point cut. But we'll get to that in a moment. So that's one I'm going to keep close on because they're very, very concerned, the board, about their lack of follow through, pick up in activity after they've already started cutting rates. So that's a concern that they've been raising. So keep a close eye on that one in particular. China's MLF announcement, almost no chance that there'll be a change there. They've already gone and cut it recently. Still far too early to go and see any impact of that really coming through in the property sector, so that's not going to go and really move the dial. And then you look at some of the other stuff coming out right now. Yes, more central bank speeches and the like. IFO business climate, soft surveys, it's not really going to go move the dial when it comes to what we know has been really important right now, which is US Treasury and the Treasury curve. Looking at some of the US data as well, they front load a lot of the information this week because of Thanksgiving. You can see here some pretty big note auctions, 2-year notes, 5-year notes, and 7-year notes will be auctioned in the United States. Given the throw effect to what it might go and do to yield, they should be on the radar and FX space. Excuse me, there we go. Just decided to go and stall me. Always appropriate time. Wednesday is a pretty important day. So let's go through that, because particularly when it comes to some of the information, and all the times here you can see on your screen are Australian Eastern Daylight Time as well. I probably should have gone and mentioned that straight off the top. So what do we have that comes up to? Well, Conference Board consumer confidence, particularly around the labour market, will be very, very closely watched, because that's what's the key driver right now when it comes to whether the Fed will pause or continue cutting in December. And then we start getting into some pretty big releases. I'm just ignore this stuff here. The surveys that are coming out. We saw the Philly, one of the regional Fed surveys come out last night. It was a horror show, and that followed one earlier in the week that was an absolute glamour show. So it's just noise. It's not going to go and give you any proper signal, and markets are already respecting that. FOMC minutes is one that is going to go and be worthwhile. But we already know that the Fed has gone and started to go and change the narrative about what they're looking at. They're already talking about the potential to go and start pausing of rate cuts coming through and slowing it down. So whilst the measures for monetary policy within the minutes should be looked at, I don't think they're going to be the really, really key driver that they may be on some occasions. So that's one thing to go and keep a close eye on as well. Then the RBNZ interest rate decision. As I mentioned before, there's a pretty decent chance, in my opinion, that they'll go 75. Markets only have a very small probability, around about 20 or so percent, that the RBNZ could go and deliver a 75. But as I said at the top, they have been incredibly vocal about the lack of pickup in activity despite rates being cut already, and markets anticipating those rate cuts and flowing through to mortgage rates, which are very, very sensitive to 2-year yields, 2-year swap rates in New Zealand. So if we get more soft data, including that retail sales print on Monday, do not discount the probability of a 75 basis point cut. I think it's much stronger possibility than what markets are giving for credit right now. And we do know the RBNZ doesn't mind to go and surprise, especially with a really long gap between this meeting and when it next meets to go and discuss monetary policy. Also, we'll get fresh data that comes out, fresh forecasts, and Adrian Orr, the RBNZ governor, will be giving a press conference as well after that decision. So that will be a bigger event than usual. Then going into here, Thursday evening our time in Asia, Wednesday evening in Asia, you can see here the core PCE deflator, the Fed's preferred inflation measure. Naturally, it's going to get a lot of attention. But, and this is, you need to remember this, so good are the forecasting techniques that we've seen from economists and shops all throughout the world, particularly in the United States, that they can go and take information from the CPI and the PPI reports that come out early in the month, and it's really rare that we go and get a big deviation from those expectations. So whilst it's the Fed's preferred inflation measure, it's not actually the bigger driver in most occasions when it comes to markets on the inflation front. Almost always, it's the CPI report that comes out earlier in the month. And even still, you can see here, so it's around about, to 2 decimal places, it's going to be around about 0.25. But you can see here right now, it's been rounded up to 0.3. 0.25 on an annualized basis gets you back to 3%. That's 1 full percentage point above the Fed's target. 0.3 is where they get you to 3.6%. That's nearly double the Fed's target. Unacceptably high levels. If that could persist, the labour market starts to go and re-strengthen again, and we saw initial jobless claims go and fall again last night. The Fed's going to have not much of a leg to stand on when it comes to cutting rates further. It will suggest that potentially inflation risks are starting to swing to the upside again. We also get the second reading of GDP growth. There should be a bit of deviation here because we've had more inputs come through. A lot of the initial preliminary data is estimates, it's got to be honestly said. So you can see here that down from 3%, 2.8% is forecast right now. The key thing is to keep a close eye on consumption. That is the key driver of US economic growth. That's the one to go and markets will pay most attention to. We'll also get the reading there coming through when it comes to the quarterly PCE deflator, but that's kind of looking way back in history, so I'm not going to be paying too much attention to that. As part of the PCE deflator as well, though, the report also has income and spending. So how to go and look at this? Well, spending makes sense, but this is not just retail sales, but also spending on services, a more inclusive and broader measure of spending. That's going to be pretty important. Income, the fuel that can go and spur on that spending. So to me, rather than being the actual deflator, the inflation print, those two are going to be pretty important. That's going to go and be a really large determinant on the outlook for the US economic growth moving forward, along with what Trump may go and do with fiscal plans that we're still yet to go and have any concrete evidence as to what's going on there. Look across the rest of the calendar, there's not a lot to go and speak of, honestly. We start to get the first of the building blocks for Australia's Q3 GDP report with CapEx, building numbers and the like. Has been a very, 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 very long time since we've heard and seen any big market reaction to those particular releases. Again, Michelle Bullock, RBA Governor, speaking as well on Thursday evening our time. I'm not sure what else she can add. She's been speaking a lot, including last night. There was no reaction to what she was speaking to just then. Then we start getting into things like German inflation and the like. But just getting back to the key point that we were talking about at the start, it's the US Treasury yield, the yield curve, Fed rate expectations that have been really, really influential in recent times. Let's go and start having a look now at some of the price action. If there's any questions about individual markets you want to go and know, please let me know and I'll get straight into it. It's been here in Australia. Let's go and kick off with SPY futures. Everyone was wanting to dunk on the little ASX earlier this week after it went and blasted to fresh record highs, took out the previous record highs, some stocks run and the like. Bit of a reversal, but you can see here, support 8310, bounced off that. If the price finishes around this level today, you'll have a pretty clear morning star pattern, albeit not at the start of after a prolonged downtrend. That to me, when you look at RSI 14, MACD trending higher, price is trending higher, buy dips. 8310 is the first level I'll be looking at. If it pulls back towards around this level, you could go and buy, stop beneath. Got this uptrend here. It's only been tested a couple of times, but the 50-day moving average, and then you could go and reset for a test of those record highs. Let's go have a look at some of the US markets. Dow had a good night, but let's go back to S&P 500. Yeah, it's hard not to like this uptrend here. Yes, it's been broken and it's a bit messy. I might actually get rid of that, to be honest. The price action itself, though, is still continuing to go and trend higher as part of a broader uptrend as well, which you can't go and see on this chart. That's how far it's run ahead. But there's not a lot to dislike about it. You can see here, it's now reclaimed that 50-day moving average, tested it a few occasions back earlier this month, bounced, Trump bump, and then you see it's pull back, and then it's gone again, bullish hammer, bang, 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 Dragonfly Doji, just grinding higher again. You can see here, volumes, while not spectacular, the latest rebound that we've seen have started to go and build. So that's a good sign when it comes to upside. Buying dips in that market too. Nasdaq survived the great NVIDIA scare of Q3 2024. Much the same picture as well. You can see here, continues to go and trend higher. This is a very long-running uptrend that goes back quite a while. Above the 50-day moving average. Didn't even bother trying to go and test it back earlier this month. Just knows it in the past that probably would go and lead to an explosive move. We've got that. Pull back. Then you can see here, 20,400. 1, 2, boom, and then on the way we go. I'll be buying dips around about this level here. Stop beneath 20,400, should I say. And you can see on the top side, 20,948, and the record highs, 21,340, 75 are the current levels to watch. I don't mind this too. You can see here over the last little bit, we saw that volumes are picking up, especially with this big wobble we saw back last Friday. but then straight away, volumes have started to go and pick up again following that bounce. So that's a good sign in the near term. Let's have a look at what's going on with crude. Geopolitical headlines left, right, and center. But yeah, I can't get too excited is not the right word. There's lots of stuff going on about Ukraine and Russia. All I'll say is that, yes, it's an incredibly serious situation, but it's been going on for over 1,000 days now. We've got a new administration coming in the United States, and we have a deal-making president-elect, and we've already seen that Russian side has started to go and reach out to go and see potentially whether a deal could be negotiated, a ceasefire or the like. So if you see big knee-jerk reactions and it's not based on anything that's actually serious, and when I talk about serious, I'm talking about launches of certain devices and the like, to me, it's just going to be an opportunity to go and buy at better levels. Anyway, with crude, bullish engulfing candle, you can see here, didn't even get really close to testing 66.33, the low we saw back in late September. And then overnight, had a pretty decent rally when it cleared 69.74, which is only a very minor level here, but it was bouncing off it a couple of times beforehand. Cleared that, then it's reached the 50-day moving average, had a look at it, it's balked, and hasn't gone on with it right now. But you can see here, RSI 14 trending higher, MACD also has crossed over from below, confirming the bullish signal. Price is trending high, you've got a price signal. It would be lovely to go and see the 50-day moving average breached and close above it. Then you can open a door up towards 72.65. But one area of concern with crude is what we're looking at here when it comes to declining volumes. There's not a lot behind it, which is one thing that makes me a little bit cautious right now. So if you are initiating longs after the move we've seen, make sure you put in downside protection. Indulging with copper. Starting to go and play out. So I wrote about this yesterday. Bear pennant, boom, 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 boom. Broken down, now you can see here, started today. Beneath that, volumes accompanying this grinding higher, corrective bounce it looks like it may end up being. Going lower, going lower. You see here, RSI 14 trending lower. You can see here, MACD still giving a bearish signal. Just given the pattern, given what we've done right now, it will not surprise to go and see $4 a pound revisited in the not too distant future. Just looks like a heavy market, just with counter trade rallies littered in between. Can we talk iron ore as well, being in Australia? Hopefully those who are still listening in don't mind me indulging in some of these more obscure markets. But yeah, for all the fundamental stories and the pessimistic outlook and supply-demand imbalance that we're likely to go and see in the future with a lot more supply coming online, the price on SGX futures is beautiful. Just, you can go and set your watch short sometimes when it comes to the price action. So what have we got here? Bearish engulfing candle, Bushka back above $100, which had gone and acted as support. Now, potentially going to act as support moving forward. Again, resistance back early this week. Broke through the 50-day moving average and continues to go on with it. RSI 14, the downtrend has been broken, you can see here, and now MACD is just flicking over from below, confirming that bullish signal. The fact that we've got above 100 and above the 50-day moving average, 106 on the downside, looms as a particular level, particularly with the 200-day moving average located just between. Let's have a quick look at some of the FX names out there as well. We're almost up about our time here, but those of you who are listening on, again, quick reminder, any questions that come through, please shoot through any messages that any markets you want to go and have a look at. Here's the Aussie dollar. You can see here, morning star after a pretty prolonged downtrend, bounced back and now consolidating in this range, 65.46 on the top side, 64.80 on the bottom. You can see here that the price has been trending higher, and we've also had MACD going confirmed that bullish signal yesterday. So right now, rangy kind of market, but the bias, the momentum suggests that maybe we start to go and buy dips rather than going to sell rallies at this point. Although right now, it's very hard to go and dunk on the greenback. It's got some pretty powerful forces behind it. Speaking of powerful forces, the euro is just immune to it. And it's really frustrated me this week. And anyone who's been reading my stuff could probably understand. But yeah, every time that it looks like it wants to bounce, it gives us a signal, a bottoming signal, just turns around and slaps you in the face. But that's markets for you. You can see here, we had prolonged downtrend, overbought, oversold, sorry. Then obvious morning star, big bullish candle, bang, 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 couldn't get through 106. And then you had an evening star formation, boom. And then yesterday, an apparent intercontinental ballistic missile launched by Russia, which ended up not being the case, but that was enough to go and push it through. And then technicals took over, and even a very, very small lift in long US Treasury yields was enough to go and push it through. Those of you who are trading euro, there is nothing, there is very little beneath 104.48 to go and hang your hat on. So that was just a minor peak that was struck back in October last year. Beneath that, there's only kind of big figures, and then you get down to a very minor support level at 102.22. That's it. So you can see here 104.48 will be pretty important. If that's breached, you could go and sell, stop above it, and then there's a pretty clear runway, at least in terms of visible support, until you get back towards the low 102. So that's one thing to go and keep in mind next week. Last one I want to go and finish on to as well. Oh, actually, two. I'll go a quick look here at dollar yen. You can see here, a bit like some of the other markets right now, it's on a stairway to heaven, just keeps going and bouncing off this uptrend. And right now it's testing it again. We saw the Japanese inflation data came out for October, was a tenth above expectations, 2.3%. And then you look at what's going on when it comes to the core reading, 2.3% annual as well. It's not enough to go and see the BOJ, in my opinion, get massively hawked up, but it doesn't go and dismiss the case for the BOJ to go and continue policy normalization at some point over the next few meetings. So potentially it could be something to go and focus on near term, but if you can't go and breach this uptrend, then you just go set longs, stop beneath, and then you can see here, stored around about 156, just below that earlier this week, and then above that 156.75. From a momentum perspective, it's getting a little bit concerned that you're seeing divergence coming through. You can see here that the price has started to go and still is pushing higher, even though we've seen lower highs being printed on RSI 14. But I've been talking about that a while. I write the weekly view ahead when it comes to dollar yen most weeks. And despite that, it's just continuing to grind high. So to me, I'm paying more attention to the price action right now. As long as this continues in this uptrend and is not breached, and particularly not closed below, it's a buy and dips play. Last one, gold. There are some that I'd love to go and talk about, but I'm not allowed to due to jurisdictional challenges, which we might get resolved at one point. But anyway, physical gold. A lot of it can be explained by technicals. Despite what's going on when it comes to treasury yields at the moment, has started to go and be able to go and push and break away from that particular relationship. Just a momentum perspective to begin with, RSI 14, downtrend busted, MACD crossing over from below, confirming the bullish signal. And then from a price perspective, you can see here, we saw this hammer candle, and then more broadly, a 3-candle pattern, morning star, big bullish move through the former uptrend. You can see here grinding higher, got to this horizontal level at 2643.50, managed to bust above that, and then yesterday took out the 50-day moving average. The fact that it's managed to go and clear this particular moving average is a bullish sign. So either particular setups, you could go and use the 50-day moving average as a level to go and buy ahead of, stop beneath, and then you've got this uptrend, which you can see acted as support on multiple occasions back over the course of September. And then again, very briefly in November before it was breached, that may now go and offer resistance. So keep an eye on that. At the moment, it's located around about 2,700. Above that, 2,710 you can see was the low where the price was snuck beneath back in November. If that goes, then we're talking about a retrip to the record highs. But the price action has been very, very positive recently. The momentum is now on the side of bulls, buy dips. That's probably the best way to describe it. So, after all that, 35 minutes. I think this might be the longest one ever. thank you to everyone who turned up. So just to reinforce again, next week, some pretty big data releases, but I don't think it's going to when it what the Fed might go and do when it comes to December. Apart from that, be very, very respectful of what prior technicals are telling you, and follow the trend, because that's what's been working on at the moment. So yeah.